On the morning of November 7th, 2005, a financial analyst named Harry Markopolos walked into the Securities and Exchange Commission's Boston office and handed over a 21-page document. The title left nothing to interpret. The world's largest hedge fund is a fraud. Asterisk. 17 red flags, numbered, with math, he had explained, in language any securities examiner could follow. Exactly why Bernie Madoff's return profile was impossible given the stated strategy. He had also noted, in the same document, that he feared for his life. The SEC acknowledged receipt. Then nothing happened. Madoff ran the machine for another 3 years after that document landed on a federal desk. Somewhere between $17 billion and $65 billion in client money, roughly the entire GDP of Croatia at the time, held in accounts that did not exist, was still moving when it finally stopped in December 2008. 3 analysts had flagged this fund before it collapsed. All 3 were ignored. What Markopolos found was simple enough to fit on one page. What happened to that page is harder to explain. Picture a country club in Palm Beach, late 1990s. The conversation at the bar isn't about Madoff directly. It's about a friend of a friend, a philanthropist everyone in the room already respects, who had gotten access to an exclusive fund. Returns that never seemed to drop. Statements that came in quietly. No fanfare. Nobody talked about it much, which somehow made it feel more legitimate. That is how $17 billion moves. Not through advertising, not through cold calls, through a social architecture built over decades. Madoff had spent years as a respected figure in Jewish philanthropic circles, in country club networks, in the feeder fund world. He had served on NASDAQ's board of directors. He had the biography of someone you do not audit. And so the people who gave him money did not audit him. They extended trust along networks they had already validated, because that is what trust is for. You cannot verify everything from first principles every time. Trust is an efficiency mechanism. It exists to save you work. Fraudsters do not exploit irrationality. They exploit rationality. They build the exact credential stack that your heuristics are designed to respond to. Then, they wait. Here is what the investor records show. Many of the most sophisticated institutional players entered through the same door as individual retirees. The feeder funds, the European banks, the fund of funds with 40-person risk teams, they had all outsourced the verification to someone else in the chain who had outsourced it to someone else. The warm introduction traveled so far that by the time it reached an institution, it still arrived pre-endorsed. An introduction is data about the confidence of the person making it. It is not data about the underlying investment. And then, in 2000, a former options trader in Boston sat down with Madoff's return records and found something the networks had missed. Something that, on paper, should not have been possible. Here is a concrete way to feel what Markopolos found. Imagine flipping a coin. Heads. The market is up that month. Tails. It is down. Over any 15-year stretch, you expect a roughly even distribution, with some streaks. What you do not expect is the coin landing heads 96% of the time, including during months when every major index fell. That is what Madoff's monthly return record looked like. Not enormous returns that would have attracted a different kind of scrutiny. Moderate returns. 10 to 12% annually, with almost no losing months across 15 years and multiple market cycles, including the dot-com collapse of 2000 to 2002. Markopolos ran the numbers against the stated strategy, a split-strike conversion approach using S&P 100 options. He found 2 problems. First, the options market for that strategy was not large enough to accommodate the volume Madoff claimed to be executing. Second, the return profile showed almost no correlation to the market conditions the strategy was supposed to be navigating. Real markets leave fingerprints on real portfolios. This portfolio had none. The shape of a return tells you more than the size of it. Any strategy that participates in real markets will show variance drawdowns, correlation to external conditions, the occasional bad quarter. A return profile that looks identical regardless of market environment is not evidence of superior skill. It is evidence that the returns are not connected to a real market. Markopolos brought these findings to the SEC in 2000, then again in 2001, then in the 2005 submission. Each time, the examiner assigned to review the case lacked the quantitative background to evaluate a derivatives strategy. Each time, the case was closed without a field examination of Madoff's actual trading records. The analysts who spotted the anomaly did something almost no one does. They wrote it down, with the math visible. What happened to those pages is what this investigation is really about. Pull up any Madoff account statement from the mid-2000s, and the first thing you notice is how clean they look. Detailed trade records, specific entry and exit prices, commission line items, asset allocations. They look exactly like a legitimate brokerage statement because they were designed by someone who knew precisely what a legitimate brokerage statement looks like. Madoff had run a legitimate broker-dealer for decades. He knew the format cold. The problem was not the format. The problem was in the custodian, in standard investment management. The firm managing your money and the firm holding your money are separate entities. This is structural protection. If the manager fabricates returns, the custodian's independent records will contradict them. For Madoff's investment advisory business, the custodian was Madoff's own broker-dealer. The entity confirming the trades was the same entity claiming to execute them. The auditor for the investment advisory business operated out of a 13 by 18-foot office. 3 employees. One of them was the owner's daughter. They were auditing a fund that, at its peak, claimed to manage $65 billion in assets. By comparison, the Big Four accounting firms with thousands of staff across global operations audit companies a fraction of that size and still sometimes miss things. Several feeder funds had conducted what they called due diligence visits. They received presentations, documentation, office tours. What none of them did was contact the supposed counterparties to Madoff's trades, the other side of those option positions, and ask whether the trades had actually occurred. The counterparties did not exist. No one had asked. For 15 years, no one had asked. In 2007, a major European bank with a 40-person risk team wired $4 billion into Madoff's fund. They had done the paperwork. They had not done the math. This is the part of the Madoff record that post-collapse investigations kept returning to, and the part that is genuinely difficult to square with how these institutions understood themselves. You would expect the retail victims, retirees who put their life savings into Madoff through a feeder fund to have done less scrutiny than a professional risk operation. That is not what happened. Institutional investors and individual retirees made structurally identical errors. Both relied on the reputation of whoever made the introduction. Both accepted documentation produced by the fund itself as evidence of the fund's legitimacy. Both assumed that because someone else in the chain had conducted due diligence. They didn't need to. The institutional players added one additional layer. They assumed that regulatory registration implied ongoing regulatory oversight. Madoff's broker-dealer was registered with the SEC. What registration confirms is that certain minimum filings have been submitted. It does not mean those filings were independently verified against actual trading records. It does not mean a field examination occurred. The SEC examination of Madoff's broker-dealer in 2003 and 2004 found no fraud because the examiners reviewed the documents Madoff produced, compared them against Madoff's own records, and did not contact the counterparties to verify that the trades had happened. Madoff understood this gap with precision. He used his regulatory registration as a credentialing signal while knowing that the examination process, as structured, was unlikely to catch what he was doing. He had spent enough time in regulatory circles to understand exactly what the inspections looked for and exactly what they didn't. His own fear that he'd be caught was not fear of regulators. It was fear of Markopolos. In a 2010 interview, Madoff described Markopolos as the one person he genuinely worried about. He had reportedly begun carrying a loaded handgun in his briefcase during the years the complaints were being reviewed. He changed his route to the office. He stopped using certain phones. The regulator he did not fear. The mathematician in Boston he did. By 2007, the following things were simultaneously true. The SEC had received 3 detailed, quantitative complaints, one of which explicitly named the fraud and provided a step-by-step methodology for confirming it. The options positions Madoff claimed to hold would have required him to control more than the entire open interest in certain S&P 100 contracts. This was checkable by anyone with access to public market data. The auditor of record had not been registered with the PCAOB, the oversight board for firms that audit public companies, until 2006, a year after the most detailed complaint was filed. On at least one occasion, Madoff told a prospective institutional investor's due diligence team that his trading system was proprietary and couldn't be disclosed, that trades were executed through a related entity, and that independent custodian confirmation was not available. That institution invested anyway. None of these signals, taken individually, proves fraud. Each is a question that requires a documented answer. Collectively, they form a pattern that every post-mortem investigation identified as having been present and documentable before December 2008. The collapse did not reveal the fraud. It confirmed it. There is a category of signal that appears with consistency in pre-collapse records across documented fraud cases. The answer that explains rather than documents. A specific question: who is the custodian? Can I see statements from them directly? Who are the counterparties to these trades receives, instead of documentation? An explanation of why that documentation is difficult to provide. Or a related document that doesn't actually answer what was asked. That explanation is itself an answer, not to the question you asked, to a different one. Whether independent documentation of this specific claim exists. The paper trail was there. What was not there was anyone structurally required to follow it. After the collapse, the SEC's Inspector General produced a 477-page report. The conclusions were specific and structural. The examiners who reviewed Madoff's operations lacked the expertise to evaluate derivative strategies. The complaint process had no mechanism for routing quantitative allegations to examiners with quantitative backgrounds. Field examinations compared the fund's records against the fund's own records rather than against independent market data. The regulatory architecture produced the appearance of oversight without its substance. This is not a story about a uniquely corrupt system. It is an observation about what regulatory floors actually guarantee versus what participants believe they guarantee. The filing exists. The registration exists. The audit opinion exists. What those things confirm is that a minimum set of requirements was met at a specific point in time. They do not confirm that the underlying assets are real. That confirmation requires a step the framework does not mandate for most investment vehicles: independent verification of asset custody by a party with no relationship to the manager. Since 2008, custody rules have tightened. Certain vehicles face enhanced examination requirements. The SEC built specific processes in response to specific gaps that Madoff exposed. That is how financial regulation evolves. Each collapse leaves a rule behind. The rule addresses the gap. The next gap is somewhere the rule does not yet reach. Go back to that Boston office. November 7th, 2005. Markopolos' 21-page document is sitting in a file. Someone has read it. Someone has decided the allegations are not credible, or too complex to investigate, or beyond the scope of what that office handles. The file is closed. Madoff goes back to work. The Madoff investigation did not reveal a gap in investor intelligence. The people who lost money included mathematicians, bankers, and professional fund managers. It did not reveal a gap in regulatory intent. The SEC had rules designed precisely for this situation. It revealed a gap between what the oversight architecture was designed to catch and what it was actually capable of catching, given how it was staffed, structured, and incentivized. That gap is where fraud lives, not in the absence of documentation. There was abundant documentation, not in the absence of oversight. There was registered, audited, regulated oversight on paper, in the space between the claim and the independent confirmation of the claim. The paper trail was there the entire time. 17 red flags, numbered and calculated, sitting in a federal file for 3 years. The collapse didn't create the evidence. It just made ignoring it impossible. That is the thing every fraud, once investigated, has in common. The signals existed before the end. What varied was whether anyone was structurally positioned and sufficiently motivated to follow them. Money autopsy. Every collapse leaves a paper trail. We follow it. Asterisk.